up? What up, SPACs Attack fans? It is opening day. Got to give a shout out to my Rays. Got to give a shout out. Hey, if you like baseball, if you don't like baseball, hit the like button. Support us as we support you guys. And welcome to the SPACs Attack. Let me bring my man, Chris Katje, in here.
Hey, what's going on, brother? How we doing today? You know, I was listening in, Spencer and Brent talking some NFT plays. Guys, if you don't have Benzinga Pro, this is why you need it, because we reach out to the companies. So you're hearing, you know, a lot of companies attached to the NFT space, and we reach out and we say, hey, what's going on? Are you guys doing NFTs? Are you working on it in the future? And we usually get comments back. So it's right there in Benzinga Pro. And, you know, shout out to Funko, the one that I called out a couple months ago, you know, but again, they had already said they were working on NFTs, and today that press release is out. I am long shares of Funko. That's my long-term NFT play, because I believe, you know, it helps grow their business that they already have existing. So enough about NFTs. Smash the like, though. Brent from the news desk joining Spencer to talk, you know, what's going on. And again, guys, Benzinga Pro is where it's at.
Like always, guys. So one of the things that we definitely are going to be paying attention to is some of the battery play earnings. So I definitely want to talk a little bit about that, but we'll get into that when we get into our headlines. Later today, we got a great interview, guys. I don't know if you guys are pouring up, but I might be on Vintage Wine Estates here, guys. Going to be with us around 11:20-ish. So let's go ahead and let's get into our headlines of the day. I know that you got us, Chris, so take us back.
Yeah, guys. So, you know, Thursday today, market is closed tomorrow for Good Friday. So today feels like a Friday, and, you know, there isn't a ton of news out there. We also did not get any deal announcements, but let's get through those headlines that we do have, you know, before we dive into our watch list and that interview. So some price targets out there. We have former SPAC Clarivate, that's ticker CLVT. Getting a $30 price target and a buy rating from Jefferies. This is one of the better performing SPACs of 2020. You know, it's been over $20 for a while. You know, we talked about it during our March SPACness tournament, and it was one that I wanted to dive more into. So nice price target and initiation here. Then we have PLBY, better known as Playboy. You know, got the SPAC deal done earlier this year. It's also being linked as an NFT play, getting a $28 price target and a buy rating from Concord out there. So, you know, interesting that Playboy is actually, you know, one of the better performing SPACs post-merger in 2021. So again, you know, keep an eye on this one. Strong brand recognition, obviously. Licensing power, and then, you know, as I said, and I have you know, written an article about, they are working on NFTs and believe that they have, you know, valuable content there going forward. And then Fisker FSR, which I am long shares, getting an equal weight $17 price target from Barclays. You know, Fisker's had quite the run in 2021. It has come down. So it looks like Barclays, you know, calling this on, you know, valuation, $17 price target. You know, for me, Fisker is more of a long-term story. They're pre-production right now. They need to get that first vehicle out, but they do have that exciting partnership with Magna International to help make those vehicles. So no concerns there from me, and we'll see what Fisker has in store for the rest of the year. SBG, which is merging with Owlet. We, of course, had the founder of the company on our show. This is the smart technology for babies. They appointed the former CEO of Livongo to the board of directors. So Livongo is a telehealth company. So to me, that's a great addition there, right? When we had him on, he talked about, you know, expanding into other areas, and to where that smart sock monitor on the baby's ankle, you can, you know, now be able to connect that directly to the health charts. And, you know, if you need to, you can call a doctor and get that telehealth platform going directly from your home where they can see and monitor, all those stats. So to me, that's a very key addition, and I think we see more from the company in that space going forward. So keep an eye out on this one, guys, if it's not already on watch. Then we have RIDE, R-I-D-E, Lordstown Motors. They unveiled 2 beta endurance pickup trucks. Again, this company has been hit, by some short reports and some concern. Did show off pictures of those endurance pickup trucks. For me, I'd like to see, the production kick in. I'd like to see the actual order numbers, because again, there was some concern over, which were hard orders versus just letters of intent. So let's keep an eye out on RIDE. One of the big movers today is QS, so that's QuantumScape, pre-revenue battery company. So shares are trading higher after they announced that they met a technical milestone that was the condition for $100 million additional investment from Volkswagen Group. So Volkswagen's been a backer of QuantumScape, but part of investing further into them was hitting a milestone. QuantumScape hitting that milestone, so getting an additional $100 million in equity from the company. So keep an eye out, on that one. Again, this company is several years away from revenue, but it's got some big backing and big names. We have VLDR, Velodyne LiDAR, also moving higher today. They announced a multi-year agreement with AGM Systems to use the LiDAR sensor in unmanned aerial vehicle mapping solutions. I'm not as familiar with AGM Systems, but it looks like people are, liking that news with VLDR trading higher. And then we have THBR merging with Indie Semiconductor. I do own shares of THBR. Company was on Mad Money last night, and this is an interesting one, right? Because it's a semiconductor play. It's a chip play. So anyone who follows the news knows that we have a shortage of chips in the auto sector. So Kramer and the CEO really dove into how is Indie going to help, bridge that gap and help with the chip shortage that we do have. So, impressive, interview there, and THBR trading higher on that news. And then XL, so XL Fleet, they announced earnings last night. So earnings per share, minus 0.06, which actually beat an estimate of minus 0.09. Sales of 10.9 million, coming in shy of a $12.1 million estimate. And then the big disappointment again was first quarter sales they see of $1 million. So this turns into another former SPAC that merged. And once those first earnings come out, they come in way different than what was projected in that investor presentation. So XL falling on the news. This is one that I owned pre-merger when it was PIC. We had that run up in the 30s and $40. I sold in that range. This one has just gotten hammered since that deal went through. And again, this is an electrification play, but this has also been the target of short reports and questions about those orders and letters of intent. So for that reason, it makes me want to stay away at this time. But I do think there is some value as an electrification play with that, Biden infrastructure plan that we did get more news on. And then speaking of, Biden, we turn to our movers. So we did have that one deal yesterday, LATN for ProCaps, up 0.1% on the day. But some of our big winners yesterday were what we call the charging infrastructure companies. So CHPT up 19%, SNPR up 5%, CLII up 10%, and TPGY up 7%. I do own shares of CHPT and SNPR. I want exposure to charging infrastructure in my portfolio. Again, we talk electric vehicles, charging infrastructure, the thing behind the thing that we say here at Benzinga. And I think they're companies that could benefit, drastically from the increase in electric vehicles. And then also Biden's plan for more charging stations throughout the U.S. And then diving into some numbers, and some stats. So we talk SPACs. We talk how there's oversupply, right? I haven't shied away from saying, we have too many new SPACs coming out. We have some bad deals being announced. We need this to correct, right? To get some interest back in the SPAC market, get some good deals done, and get some good, SPAC returns for investors. And I'm happy to say that yesterday there were no S1s filed, no new SPACs. We also had 2 SPAC IPOs canceled this week. So I think that's positive, in the oversupply issue. And then we have some stats out from our friend of the show, Julian Klimachko. So in March, we had a record set for a month with $33.1 billion raised from 110 IPOs. And for the first quarter, we also set a quarterly record with $87.3 billion raised from 298 SPAC IPOs. So those are some pretty big numbers. And again, both setting a monthly and a quarterly record here at the end of March. And then also I want to highlight the deal inflow. So in January, we had 17 SPAC mergers announced, February 44 SPAC mergers announced, and March 33 SPAC mergers announced. We start a new month today of April. My guess is that we get less than 33 new deals this month. So I think that downward trend continues from that peak of February. I'd like to see closer to 15 to 20 deals this month. Maybe some good deals, but we do also have a lot of SPACs outstanding that need to get deals done or liquidate. So lots of things to think about. That's what I've got, Mitch. We do have that vote for NPA on their merger set for today, but otherwise calendar, again, with the market being closed tomorrow, looks pretty open. So that's what I've got for you.
All right. Hey, so one thing I did notice that you talked about was, the infrastructure and the battery plays. Now, one thing that I want to note here, and I'm getting this really from kind of Morgan's note on Romeo Power, and it's something that I think everyone needs to pay attention to. So I don't think it's being spoken enough that today's supply problems might lead to a demand problem. And so one of the things that I want to stress is that, for a long time, we thought that, the potential for industry-wide battery problems and shortages could happen for like the next couple of years because of the kind of the material shortage. And so one thing I'm noticing now is it could be faster than everyone thought. I think they thought that Romeo Powers was at least going to be able to get things moving here. And, one thing I noticed is that pay attention to the other ones. I think they're going to run into some supply issues also. So it's not just Romeo Power that's probably fighting some supply issues in this market. I noticed that, there's some shortages, whether it be in a lot of places. The supply chains are messed up, guys. So pay attention to that. I think that's so vital for this industry, so vital for EV, because if the supply chain is going to have issues, if the supply problem leads to a demand problem, what's going to happen with these EV stocks? You can fill in that question for yourself, guys. And it'll be interesting definitely to watch in the next couple of days. All right, guys. So one thing I want to get into is before we kind of move forward, there is some stocks that are up a significant amount today. So wanted to mention, definitely, we already mentioned VLDR and QS, THBR, but also up about 6%. We got Silver Spike Acquisition, SSPK here. I'm going to go ahead and put up the chart right quick, just for a quick second before we get to our interview. This one's interesting. It's down near support, has bounced off of that 18 multiple times. What do you think about this one, Chris?
Yeah, so SSPK, and I do own a small position in this. This is Weed Maps. And what are we getting? We're getting lots of positive cannabis news again, right? We just saw New York. So to me, again, this is more of a thing behind the thing, right? You can own the growers, you can own the stores, or you can own a company, like Silver Spike, that's going to work with a bunch of different companies and kind of connect it all. So to me, that's how I want to play it rather than picking and choosing. I want a company that's going to benefit from the overall growth of cannabis. So that's why I like the story. What do you see on the chart there, Mitch? You're liking it? It looks like we're getting some support there.
Yeah, definitely. One thing I'd say is that support there off of 18 is definitely holding well. Multiple days where it's touched it. This is the 1 week chart, so you get to see it a little bit clearer here. But I would definitely pay attention towards that 18 now. That 18 holds, it's still going to be looking good to get maybe back up there towards that 28. And like you mentioned, this could be a reopening play within itself, right? Because, maybe you get demand to increase And you're mentioning things that I'm watching, state by state. If we keep getting to more legalized states, eventually I think federal turns, but state by state brings more revenue, just like it does in betting. So I'm definitely going to keep an eye on these. There's a couple companies that you could watch out in the New York market. I heard the Cannabis Insider boys talking about this. So shout out to the Cannabis Insider boys. If you guys don't watch Cannabis Insider, definitely watch that if you like these cannabis stocks. They mentioned Cureleaf. They mentioned also MedMen has some kind of the market share in New York already with a Fifth Avenue store, or I think a very, very, very pricey store. So I'll keep an eye on those. And MedMen is one that I watched for a long time. It was a big debt kind of cash cow, and that's one that I'd watch out to see what happens with the debt, to see if it can kind of clear that debt. But hey, we'll see what happens with these kind of cannabis companies and keep moving on. All right, let's go ahead and let's get into our interview for today, Chris. I'm excited to go ahead and pour up a little bit here, but let's go ahead and let's get into our interview.
Yeah, guys, super excited. Another exclusive interview here on SPACs Attack. So joining us today, we have Pat Roney, the CEO of Vintage Wine Estates, and Mark Harms, the co-managing partner of Bespoke Capital. This is a merger deal being done. Ticker is BSPE. Welcome, gentlemen, to the show.
Thank you.
Thanks very much, Chris.
Loving that lineup you've got behind you, Mark. That background looks a lot better than mine with the wine there. So
it's due diligence.
There you go.
Yeah, might have to go to Mark's house after this. But
if only we could have done a live interview somewhere. For this story, this would have been the one.
We do
virtual
some great
tasting.
virtual
Anybody?
Tastings too.
Yeah,
virtual
you see.
Okay.
You see, I knew it. I knew it.
That's
I'm looking forward to
those.
Hey, if anything, we might have to join the next virtual event. I know you guys have events also, not just tastings. So we'll definitely look forward towards that. I'm going to let Chris do some questions, and I'll be back with some of my own.
Great.
All right, guys. So going to try to get questions, for both of you, but feel free to jump in if you have anything to comment, for any of the questions. So, I'm wondering if we can start with you, Pat. Just give us a brief background on Vintage Wine Estates and what you're all about.
The great thing, so Vintage Wine Estates, we're a $200 million revenue company. We're in the premium segment of the wine business. We have over 50 brands. We've grown on our top line over the last 10 years, a 21% CAGR, and a 24% CAGR on our EBITDA. We're a highly profitable company, and we continue to look to grow the business. And we have a very strong organic growth in our business, and we do a lot of acquisitions. We average 2 to 3 per year, and we anticipate continuing to grow through premiumization, innovation, as well as acquisitions. And so we focus on wineries in California, Washington, and Oregon, and our business is highly diversified, and that 30% of our business ships direct to consumer. 30% is with exclusive brands with our major retail partners in the retail segment, and then 40% in the traditional wholesale market. So very well diversified company, growing through the pandemic, and excited about continuing to bring in new capital so we can make additional acquisitions.
Awesome. And then Mark, you just give us a brief background on yourself and Bespoke Capital here.
Sure. So I've been a private equity investor and merchant banker for way too many years, as you can tell by the lack of hair. We have a focus on leisure, consumer, and supply chain. We are a unique firm in that we look for long hold investments. When we tried and we started out our SPAC as a cannabis SPAC. That's why we listed it in Toronto, and we found it was almost impossible to find high quality targets to acquire, to the point of your previous discussion. So we quickly pivoted. We are lucky in that we have Paul Walsh as our lead operating partner and the chairman of our SPAC. Paul was the CEO of Diageo for 13 years. He and his team created over $80 billion of shareholder value during his tenure as CEO, and he built the world's largest spirits company. So when we decided to broaden our search beyond cannabis, wine was a very natural extension. And we were lucky enough to find Vintage Wine Estates, and we said, this is actually the perfect acquisition for us. We can add a lot of value to the business. My partner, Rob, and I have been investors in one of the world's largest wine closure businesses for the last 6 years, a company called Benzinga. Makes about 3 billion screw caps and corks for the global wine industry. So we know a lot about the supply chain. We know the potential targets, and it was really a perfect marriage. Why are we investing in Vintage Wine Estates? We love the business in terms of its market position. It's in the most rapidly growing part of the wine industry, historic and forecast growth of around 6% organically. The company, we're expecting to grow at 9 or 10% because of its strength in the direct-to-consumer business, in the exclusive brands business. Direct-to-consumer through COVID has been growing at north of 10%. The exclusive brands business at around 25%. So we have a very powerful platform that the company's built in terms of its three-legged distribution stool. And because of the capital investments the company has made into bottling and distribution, the company is extremely well positioned to really grow its margins going forward. So we're expecting the company to grow at about 9% organically, another 9% or so through one acquisition per year, and EBITDA growing in the high teens organically and north of 30% with one acquisition. So compelling. And from a valuation standpoint, what we were able to do here with Pat, because we're all long-term shareholders, this is a 18-month lockup, nobody's selling any shares other than a small amount going to existing shareholders. We've priced this at less than 13 times next year's EBITDA and 21 times on a PE basis. And nobody's talking about earnings for SPACs these days. This is a real company with real cash flow, very strong growth potential. And you measure it up against Duckhorn, the main competitor, and Duckhorn's trading at a 21.5 times EBITDA multiple next year and a 45 PE. So in my mind, it's pretty simple as to which one you buy.
Awesome, Mark. You hit several of my questions that I had for later on. You already knocked them out of the park. So we'll circle back to some of those, but great, thesis into the investment in vintage wines. I turn over to you, Pat. So you have this company and, you could do several things with it. You could keep it, private. You could go public via traditional IPO, or you can go public via SPAC. Why the decision to do a SPAC merger and now?
Well, that's a great question. You're absolutely right on all three of those alternatives, and we evaluated all three of the alternatives. We've been looking at taking the company public for probably 4 years or so, and we actually talked to several other SPACs, and we hired Cowen and Company to get us up to do a traditional IPO, and then we met the Bespoke team last August, and there were a lot of very, very intriguing things for us. One, the size of their SPAC in terms of matching up to put us back at a basically a zero net debt position on a go forward basis, and then the team, the people in the team with Paul Walsh on there. There was 13-year run creating $80 billion of shareholder value at Diageo, and it was really, we're running a page out of his playbook, which was growth through premiumization, growth through innovation, and acquisition. And then Mark and Rob, had a 6-year plus investment in Inventions, one of the world's largest closure companies in the wine industry. So they understood the industry. They had a lot of contacts with it, and very, very strong in the financial and capital markets. And it just made a lot of sense to me, and a great marriage. And as one of the major shareholders and somebody that's not going to sell for at least 3-4 years, I wanted long-term partners, and I wanted the opportunity to continue, to grow our company. And it's at some point, even though I've been running the company as my own personal LBO shop over the last 10 years, you need more equity to continue to grow. And we're 200 million revenue now. I see no reason why we can't get to 500 million in revenue very shortly, and $1 billion in revenue. And so it was a great opportunity to get the capital and continue to grow the company.
Awesome. And, sticking with you, Pat, we talk acquisitions, and I heard Mark mention it too, talking about doing or kind of pricing in for one a year going forward. So you've grown a lot through acquisitions, doing, more than 20 here listed in the press release. why are acquisitions so important to the business going forward, Pat?
Well, the acquisitions, again, without acquisitions, we continue to grow at high single digits at 8 to 9% growth, and that's a nice little growth rate in and of itself. But the industry is consolidating, and we felt that while we've got a financial plan that says just one acquisition per year, we're probably going to do 2 to 3 acquisitions per year. That's our history, and it just allows the company to grow even faster and become more important in the marketplace and all the segments that we do. And we think we've been able, over the last 10 years with 20 acquisitions, we've proven that we can do roll-ups, and we understand how to do it. And we think that it's just an additional lever and an opportunity for us. And we're very disciplined when we look at it. We don't chase 22 times EBITDA high flyers where you have to increase your business 300 to 400% to even think about a return. We work for opportunities where the seller thinks that they're selling at 8 to 12 times multiple of EBITDA, but we know on a post-close basis it's going to be 4 to 6 times because we consolidate, consolidate the production, we buy dry goods better, we take out the G&A and we put on our own wholesale and marketing team. So it really creates great value for us and great value for our shareholders, and it's working for us, and so we're going to continue.
Awesome. So, Mark, turning back to you mentioned some of the thesis for the reason for investing in vintage wine. As a SPAC, you have your choice, lots of different companies. The thing that I saw that struck me was not only the acquisitions, but it looks like expansion plans. So expanding the production capacity, to 15 million cases, up from 7 million, with a high-speed bottling line investment in new warehouse and distribution centers. There's that slide there. Can you walk us through that, Mark? How big of a role did this expansion plan from Vintage Wine, play into the SPAC merger deal?
It was important to us because the company, unlike a lot of LBOs, the company actually is investing in its business for growth. And the platform that they created with this expansion of the bottling capacity in the warehouse means that we as the public shareholders are going to benefit from that, right? We're going to see a very rapid increase in our EBITDA margins and our gross margins as a result of that expansion. The company has increased its EBITDA margins by almost 5% over the last few years, and we expect another 5% as a result of the work that the company's done from a CapEx standpoint, putting us at truly best in class in terms of the industry from a margin standpoint. And we think that platform you can add a lot of businesses to. We know that M&A is tricky and can be tough. We've been involved in roll-ups that have worked and roll-ups that haven't. And part of history is a great judge of the future. And what Pat does is he buys brands, inventory, in certain cases assets, but not necessarily fixed assets, plant and equipment, a winemaker, and overhead that matters. The rest of it just goes away. So, you can very quickly capture a lot of synergies, and you put it on the platform and you drive on. The company has over 50 brands. There's not one brand that is 70% of revenues like some of the competitors. We like that. We think that diversification is great. And, it's one of the things that attracted us to the business.
Awesome. Yeah. So, you just mentioned price points. That was one of the questions that I wanted to ask. So Pat, you've got, over 50 brands. You've got a price range at $10 to $150. Why focus on so many different areas of the wine market in terms of price?
Yeah, so the one area we don't really play in is the value category, the sub $10 category, because we don't think you can make margins at it, and it's a very competitive category. So we'd like, and it's also a category that's not growing; it's actually declining. So we like being in the premiumization category, and we like the fact of having multiple brands really diversifies our risk. We don't have any single brand that's more than 12% of our revenue. So if one brand slows down a little bit, we've got plenty of others. And so we've got a multifaceted distribution base to go after the business. And we have a lot of diversification through through the types of brands at various price points that we have in various wine styles. And so it adds a lot of diversity for us, and it de-risks the company.
And the company has long-term relationships with some of the largest retailers in the country: Costco, Albertsons, Kroger, Target, and they partner with them and they provide them with exclusive brands, but also the ability to sell additional brands, right? So, it leads to more shelf space. And, as you look at this growth opportunity through scale and distribution, you can see that, in Kroger, we have a couple of major SKUs. They want more. So does Target. There's probably a 1 million plus case opportunity for the company off of a base of 2 million, just expanding what we currently have with these customers. They are desperate for innovation. And Target, for example, the company created this new brand, Photograph, which just got launched. And anybody who's near a Target that sells alcohol, you should go check it out. We expect that to be quite a large brand, and it's exclusive to them for a period of time. And then we have the ability to take it nationally. They did that with Bar Dog very successfully. And so it's another one of those legs on the stool that we think is really powerful. And, we have the ability to market virtually all of our brands on a direct-to-consumer basis. Unlike the spirits industry where you can't sell directly, you have this 3-tier system. Great news about wine: you can go direct to consumers in 46 states in the United States. And the platform that this company has built is unique. Most of the other winery companies, they're lucky if they have 10% in terms of direct to consumer. And most of that's coming from a tasting room that was closed for the last 12 months. So our guys actually grew the direct to consumer business by 10% plus during COVID, with half the business closed, which tells you the power of the diversification approach.
Yeah, awesome. That sounds great with that Target deal there. I'll have to check that out. Mitch, what do you got? I know you want to hop in with some questions here.
Yeah, so one thing I was looking at is looking at some adjacent opportunities here being mentioned in the investor presentation. So, of course, what stands out to me here on the right-hand side is when federally legal, but of course, cannabis-infused beverage. Can you tell me a little bit more about what are you guys thinking about this market and how do you guys see it growing?
So we know a lot about this space, right? Given we looked at over 100 cannabis companies, and then we looked at a large number of consumer companies, CPG businesses as well. And the company has 1,100 licenses, liquor licenses. We do not want to jeopardize those. So we're not going to play in legalized cannabis until it's federally legal or decriminalized. And having said that, Terry Wheatley, the president of the company, is the chairwoman of the second largest cannabis business in California. They already have formulations ready to go. And so we can be a leader, not just a fast follower in the cannabis infused alcoholic beverage space. The company, in terms of innovation, and it was the slide before, has introduced a wine cocktail called Gaze that's doing extremely well on QVC. Innocent is a low/no alcohol beverage that is being introduced with HEB in Texas. So the company has a lot of experience around innovation and innovative routes to market to really drive this continued growth.
Yeah, definitely. And also I saw mentions on there, and maybe Pat could add a little bit. You guys seen the transition of kind of this seltzer move? Are you guys thinking about stepping in here, at least with kind of seltzers?
Yeah, in terms of the seltzer category, and back early on in my career for the baby boomers, I developed Seagram's wine cooler and took it from 0 to 20 million cases. And what we saw in that category was the same thing that I believe we're going to see in the seltzer category, where there was a proliferation of brands, 60 to 70, and then it ultimately, within a couple of years, collapsed to 1 or 2 major brands. And I think that's going to happen in the hard seltzer category. It's a very expensive category to get into. So on seltzers, the only thing that we really will do is if one of our exclusive label customers wants their own brand, we'll do that for them. Otherwise, we're actually more focused on perhaps the hard cider category, which we see as a slower growing category, but a very significant in volume. And that's a great platform to get into the ready to drink and a lot of things that the millennials are looking at with flavors and single serve kinds of things. So we'll look at that shoulder of the wine industry a little bit more closely. And of course, the cannabis infused beverages when it becomes legal to do it.
All right. So I got one more question here. It's also based a little bit about what you were already talking about, Mark, but, the ways that you guys win here. So one thing that definitely stands out to me on the direct to consumer side is how you mentioned QVC. Can you explain me a little bit more about how that actually affects this area?
Sure. Well, so the company, and I can't tell you the exact number because I can't, but the company and Kevin O'Leary just sold a whole bunch of wine on QVC. Kevin O'Leary Fine Wines is one of the company's partners in that aspect of DTC. And the company is, I think, by far and away the market leader selling wine on QVC. And so we think that if you think about the direct to consumer, there's actually several legs to the stool. The first is pure e-commerce. Cameron Hughes is the largest digitally native e-commerce brand. Tasting rooms. The company has 14 tasting rooms, 36,000 wine club members. Another very powerful and very sticky group of people. The third is QVC with Kevin O'Leary as the masthead, and he is very excited about the business. The fourth is the company's ability to expand into telesales as well. The company does very well with Windsor, which is the original telesales brand. And then you have the tasting rooms themselves. And we expect the tasting rooms to come roaring back now that California, Washington, and Oregon are back open again.
Yeah, definitely. Can you let us know a little bit more about the kind of the tasting rooms, Pat? And also, I did see kind of virtually even events. I had that over here, but the virtual tasting events. So I might have to join in on one of those.
Well, we'd love to have you do that. That would be great. And so we all of our tasting rooms, we've got 14 of them across the country, across California, Washington, and Oregon. And it's a great opportunity for consumers to come and try our wines. And now with the pandemic, we're doing virtual tastings with all of our different wineries, and people are having a good time. And they sign up to do the virtual tasting, and we send out 2 to 3 bottles of wine that they get to taste and sample. And we have our winemakers on, and it's a lot of fun.
Yeah, we actually did that for 45 research analysts for an analyst day earlier this week. Great fun and very, very successul.
Yeah, I like the idea. I might have to start getting into my wine.
Well, we're happy to do it with you guys if you for a group of your.
I was just gonna say we do Friday unwinds. It used to be happy hours in the office, but especially with so many people, both of us included, working from home, maybe we should set this up for a Friday unwind at 4 p.m. Eastern time to do a virtual wine tasting. We would love that. So I've got one more question, and then we're gonna ask some questions from the chat that we. So, Mark, I want to turn to you. You said something earlier, and I want to touch on it. We talk about SPACs so much, and there's been a lot of recent talk about lockups and expirations, and investors selling out of these SPAC deals early. We saw a call yesterday from Andrew Sorkin on CNBC to actually extend the lockup period. You mentioned 18 months. I just want to get more on that. Why 18 months, and why is that so important on the long-term success of a SPAC investment here?
Sure. So, and I'll share with you a little bit of our views on SPACs generally. We think the economics are incredibly rich. We're used to private equity where you have an 8% hurdle rate that you have to clear before you make any money. And we're not used to this concept of 20% off the top and just with no performance hurdles. So we think that's going to change, and going to change pretty rapidly, and for the better for investors. So what are the important things from an investor standpoint to align interests? One is to make sure people aren't selling. And I think the sponsors of the Virgin Galactic SPAC demerger, literally 6 months and a day later, a bunch of stock came out. That's not us. We thought it was extremely important to have the longest lockup in the SPAC industry, and 18 months, as far as all of our research shows, is the longest lockup. Now, we marry that with a deferred share component in our structure, such that Pat and the existing shareholders will receive additional consideration at $15 and at $20 per share. So they're totally aligned with the share price going up. And so our view is the more alignment you can create between the public market investors and the private market investors in a true merger fashion, the better off everybody's going to be. And we definitely see this SPAC mania, and we're I think suffering from the fact that this is a real company with real management, real cash flow, great growth prospects, and is valued based on EBITDA and PE as opposed to some electrification play where you might be lucky to generate some profits in 2027.
Awesome.
Yeah, definitely. One thing I'd mention is that there's one thing that we definitely stress on SPACs Attack, guys, is revenue. So I appreciate you bringing that up.
Profitability.
That's profitability.
A key I saw too. Profitability. That we don't see that all the time in SPAC land, So again, this is BSPE. Want to get to some questions from the chat. So up first, probably for you, Pat, and I don't know the answer to this, but John Doe from the chat asking, do they have any partnerships with athletes? So possibly talking about, celebrity endorsements. Are there any wines that you have out there that have deals or any plans in the future?
Well, we always look at opportunities like that. We currently don't have anything with an athlete or a celebrity along those, within the athletic space. I mean, we do things with Kevin O'Leary at Shark Tank. We do things with Valerie Bertinelli on Food TV Network. We did a licensing deal with, which is, because it's off the air right now, but with HBO and Game of Thrones. And so that was a great selling wine in that kind of opportunity. So we'll always certainly evaluate those and certainly consider those opportunities. And just before I forget, too, I should mention, since we were talking now, we've got the open space to all the investors. One other interesting play that we do offer people that actually go out and buy stock in the company is our wine passport program, where people that are investors get a 15 to 25% discount off of ordering our wines directly, and they get access to all the VIP events at our various facilities. So it's another great reason why to go out and buy some BSPE stock or ultimately VWE.
Awesome. So another question from the chat here from Thomas, a loyal listener of our show. I'll turn and ask you, Mark. You mentioned, that the pricing kind of is for one acquisition a year. Sounds like Pat, maybe more based on past history. But the question is about the geographic acquisition. So are they making acquisitions overseas? So maybe give us, Mark, your thoughts on, will we see lots of domestic acquisitions, international, both, kind of what the mix is going to be forward looking?
So this is the only CPG category that has over 10,000 participants in it. 10,000 wineries. Over half are independent. A recent Silicon Valley Bank study indicated that over half of those folks are going to sell in the next 24 months. Why? Because most of them were reliant on wholesale, on the on-trade, which is basically restaurants, and a tasting room. They didn't have all of the diversification that we do. And they're realizing that this is kind of a hard business now. So there's going to be a golden age of acquisitions. In terms of focus, Pat likes to be within a 2-hour flight of whatever he owns. So I think you can safely say it's California, Washington, Oregon. We don't really need or want to be in New York or Texas, much as they're great states. The wine isn't that great.
Awesome. And then a non-financial or SPAC question, again, from Thomas in the chat. So asking, can Pat recommend a nice Chardonnay for happy hour tonight? So what do you got from that portfolio of brands? Or looks like Mark's got one to grab there too. So how about each of you give us, a Chardonnay pick here for Thomas?
Well, Mark looked like he picked the BR Cone Chardonnay, which is a great Chardonnay. I'm going to go with the Gerard Chardonnay. It's a great Chardonnay out of one, which was our first winery. But those are both great ones. And Cundy Estate Chardonnay, Sonoma Valley, is another great one.
Yeah. So BR Cone was the Doobie Brothers manager for folks of that vintage. And there's a great music festival every year, except during COVID there. And fabulous wine.
Awesome. Well, we will have to keep both of those on our list for when we do that virtual wine tasting, hopefully in the future. So we'll look forward to setting that up. So, I want to thank both of you, for taking time out of your busy schedule, joining us on the show again. So again, Vintage Wine Estates, we have Pat and Mark here going public with BSPE in a SPAC merger. Thank you both, gentlemen, for joining us on the show.
Thank you so much. You guys asked great questions.
Well, thank you. We appreciate that.
Yeah, definitely. We'll definitely have you guys back, and we'll probably have you for that virtual tasting.
That'd be
so looking forward to it.
And it looks like the chat enjoyed it, and looks like you might have some buyers out there for shares. So, awesome interview, guys. Have a great rest of the day.
Thanks a lot, guys.
Take care.
Yeah, bye-bye.
Hey guys, you guys heard it first here, guys. I might have to go to the store right now and get some wine tonight. Talking so much wine got me interested. And Thomas, I can't blame you. A little Chardonnay or maybe a Pinot Noir or what do you like, Chris? Are you a Merlot kind of guy?
I'm more of a white wine kind of guy, but I also enjoyed hearing more about, the cider and the seltzer and that cannabis infused, expanding beyond wine. I've never been a big wine drinker. I actually, have been, getting more into that. But I came from, here in Michigan, the craft beer side of things. But I love the recommendations there. And, the thing that jumped out for me was that deal Target. That sounded exciting to me, getting that exclusive wine in Target stores that they can really, expand there. And then also they can take that brand nationally after that exclusivity runs out with Target. So, and it sounds like all those retailers, Mitch, they want more wine from this company. That's a bullish sign to me. So.
Yeah, I'm going to have to take a look at these, but, one of the good things is you can find them in just about, you saw all those stores that we mentioned.
All those stores, holy cow.
It's not like it's just in one store, two store, three stores.
You don't have to go to their winery to buy it.
Nah, and one of the things that I noticed is that I think they're doing smart and not going by, like, let's say underneath that $10. They're finding where the margins actually make money. And one thing I can notice is that, at least, this is strictly my opinion, but I don't see them as being focused as like, oh, we're just a wine company. We don't care about our revenue. and that's how you might find in the wine industry. Sometimes that's going to happen. There's going to be people that care so much about the product that they don't care about their revenue. It seems to me like they've gotten it down packed. They've brought in over 90 plus rating wines. So 90 wines, 90 bottles. It's not like they've had success in 1, 2, 3. It's not Barefoot with five wines to their names. 90 rated wines is not easy to get, guys. They got some of them rating as high as 96. 96 is pretty good, guys. I'll tell you that right now. Anything over a 90 is pretty much like high class, like top of the line for wine. So we're going to keep an eye on these. And one thing I'd mention, even if you're not the kind of wine person, if you're like me, maybe back in the day, opening up some box wine and celebrating with the college boys. But hey, I've had my time. I've moved on from that, and I'm looking for some good wine. So I'm going to go to the store after this and maybe get my fiance a nice bottle.
Yeah, we talk SPACs. We talk, about a lot of these EV names, a lot of these pre-revenue names. Guys, you heard it here, right? Revenue growth organically and through acquisitions. Profitability, that's a P word we don't hear all the time here on the show. And then that 18-month lockup expiration, right? We didn't really touch on that, but yesterday, Andrew Sorkin on CNBC talking about, making these investors, hold shares longer, even all the way out through their investor presentation estimates. I don't necessarily agree with that, but 6-month lockup, I think, is a little on the short side, as Mark alluded to with Virgin Galactic. We obviously know, what happened there. But 18 months, I like that. And I think it shows, a belief in this company's growth plan going forward. So, there's a lot of, again, in my opinion, a lot of bullish signs here, around this company and this SPAC deal.
All right, guys, we're going to go ahead and get into everybody's favorite time here. It's time for ticker time, guys. We got about 8 minutes left, but I don't see Luke anywhere near here. So let's go ahead. Ticker time. All right, guys. It's looking like everyone in the chat enjoying the talk, talking about some craft beer too. I can't blame you. I mean, I'm in Colorado. This is like the state of craft beer, but I won't get into that. But let's go ahead and let's get into some stocks, guys. If you got something that you want to take a look at today, let us know in the chat and we'll start running through here. Kevin O'Leary, we're going to have to reach out with him, get a virtual wine tasting with these guys and sit back, relax. Kevin's a wine expert. So if he approves of this company.
That comment from Carl is spot on. If Kevin O'Leary is involved, and again, Kevin O'Leary does a lot of smart deals, but he knows his wine. So
that's one of his favorite subjects.
Yeah.
Literally, you could get this guy to talk hours and hours on just wine.
Yep.
So, he's not too much of a heavy drinker, but if you talk about wine, you'll see Kevin O'Leary get excited for sure.
Yeah, for sure.
So
what do we got for tickers, guys? What's out there?
Let's go. Let's see what we got. Of course, QS. I mean, we talked about QS already, so I don't think there's really any need to go into QS. I mean, we already talked about what was there, but let's go into CLOV. Someone's still holding on to this, it seems like. I can't blame you. I mean, if you're in it now, you're probably in it to win it. Like I sometimes say, and when you're in it to win it, sometimes you might get burned. You might become a little bit of a bag holder. But in this case, I don't think it's the worst chart. You're still seeing kind of this leveling area through the 7s and the 8s. So to me, that's starting to be the price where I think it's starting to level out. You might get a day where it spikes underneath that 7, but I really think the price here that it's starting to level out is near that $7 and $8. That's where I'd kind of pay attention to CLOV. Let's keep rolling through here. I know you don't really care too much about that one, Chris.
Yeah, aside from the chart, for me with Clover, the story is they need some new deal announcements, or you might have to wait until that next earnings report. But that last earnings report was a disappointment. So story-wise, there is not a lot of news there.
Choo coming in with TPGY, the D train coming in. What's up, guys? I gotta ask, D train, was that from Dontrell Willis, or like the actual guy that used to be called D Train from the Marlins? I don't know.
I remember that Dontrell Willis, that exciting windup. He was a Tiger for a little while too. So TPGY was one of the stocks I mentioned as a charging infrastructure play, and shares were up significantly yesterday. They're merging with EV Box. This is the large charging play in Europe. So to me, they talked about expansion in the U.S. What a time if they can get more expansion in the U.S. with that Biden plan. I'm long CHPT and the other one, Volta charging with SNPR, but I'm liking all these charging plays. I think it's a huge growth area going forward. That's my thought there. What do you think about this chart, Mitch?
It's not a bad looking chart. You got 1, 2, 3, 4 weeks kind of getting that 18 look, 18 bottom. One of the things we always talk about is when you have those big wicks on the bottom, that's buying pressure, stepping up somewhere, I would say, in between that 18 and kind of the 1750s, 17 area. That's where I think the majority of the big buyers have stepped in. And so one thing I'd pay attention to is if we could start clearing this high right here from this big bar on December 7th, which is the 24 mark. Pay attention to that mark. If you get a strong volume through that, then possibly we can get back up there towards that 34. All right, let's keep rolling through here. Got a couple more that we can get into. I am seeing one that was mentioned here. Let me find it again. Peso, I see you, man. NEBC. What's up with this one, Chris?
Yeah, NEBC, pulling it up here. This is Rover. So we actually had the CEO of Rover on Power Hour to do an interview. And, this is a play on the pet growth, right? We're seeing more pet ownership through the pandemic. And the thing that struck me was, they're the largest dog walking company in the country, but the base of their largest portion of their revenue is actually from the pets sitting and overnight business, right? If you go, to work and you need someone to watch your pets, or if you go, out of town, Rover's the company, helping with that. So I liked hearing that from him.
As a user of Rover, I am going to have to say that definitely this company is on my radar. I'll be, full disclosure, guys, I got in at $9.98 and then I sold my shares right at $9.98. Reason why, I just didn't want to stick around through this sideways period of time, but I do think I like the company overall. We've talked about it. The travel is going to come back, but travel isn't going to come back in business sense. I think it's going to come back more in a consumer kind of personal travel, vacations that you're going to see. And because of this, you'll probably see kind of Rover get a revenue increase and a boost when kind of we really start traveling again. So it's definitely on my radar. But there is some competitors in this industry, so be careful there. But definitely the top known one would be Rover here. So definitely going to keep an eye on this one. Let's keep going through here. Seeing mentions of, let's see. What do we got? All right. I got you, John Doe. I'll talk about this one. PIPP. I know this one's cheap right now, so that's why I'll bring it up. What's up with this one, Chris? Has they mentioned any rumors about this one or anything?
I have not seen any rumors. This is one, 1002. This one looks great. This is a great team, right? We talked about this one all the way back when Biden was first, sworn in. This has got some former, connections. And then we also have, some key names from the defense, the government, and the aerospace industries. That's the market that they're targeting. Pine Island acquisition. I have not seen any rumors, but this has been a favorite of mine based on that management team, the share price, and then also the target industry, for growth going forward.
Yeah, we'll keep a look on that one. John's talking about here potential new board member from NASA. I'll have Chris look into that. And
I'll have to look into that. But that definitely, hey, if you've got a target area of defense, aerospace, government, and all of a sudden you add someone from NASA, maybe we see a space acquisition here. So that's definitely an interesting point. Thank you for bringing that up. I don't remember seeing that anywhere, but we'll definitely take a look at that.
All right. So let's keep going through here in the comments. Next one up, FCAC here, mentioned by Sambrowski, my favorite name out there in the chat. Shout out. FCAC here. What do you think, Chris?
Yeah, so FCAC, I actually should have brought this up in headlines. So they're merging with ShareCare. They actually had a new investor present that came out yesterday. I haven't had a chance to dive into it, but it looks like they actually upped their financial projections, which, right, is a positive compared to these companies that are, reporting lower than what they estimate. But I own shares of FCAC. To me, this is an emerging health play, but also remember, they're the company that is a reopening play, right? They're going to be able to certify these arenas, these concert venues, and say that, people are safe, they're vaccinated, that the place is clean with that ShareCare program. So to me, I like it, and I am still holding my shares here.
All right. I'm going to go into another one here being mentioned by someone I think is kind of concerned about their investment here. But fun name here. I'm going to have to go check them out. Painting with a Twist out of Coral Way, Miami. I know exactly where that is. So definitely I'm going to give you a shout out here. I used to be down there all the time, Coral Way or Miami Beach. I miss my Miami, but to talk about XL here, one of the things that I'd say is that I mentioned is the same thing kind of mentioned that I mentioned with Romeo Powers is I think there's supply issues here, guys. I think there's demand issues. And with that being said, I know that a lot of people are talking about EVs and the quick transition, but I think it's going to take years, guys. It's not going to be something that we're going to see in this kind of next 4 months, just massive amounts of EVs just hit the market. So I think, this is one that you got to stick around for the long run. If you kind of got caught, I don't necessarily, I wouldn't say to get rid of it, just because I think it can come back. This stock does have some potential, has some partnerships, and can come back. But I think it's just going to take a little while for XL Fleet, Romeo Power. And for that point, you can look at some other ones, Nikola, you can look at Helion, you can mention those all around. And I think, it's going to take a little while for these to really, really start getting that revenue drive. Chris and I were talking about it on the pre. Look out for Q3. We're not really feeling Q2 that much, but Q3 we definitely are feeling a little bit more. We think that we could get the drive back. And if you look at the GDP numbers, it would kind of support this too, because we're looking at the end of the year to really get that growth run. So I'm keeping an eye on these guys. Let's keep going through here. Let's see what else we got in the chat here. Jay says XL will never see 10 again. I will take that lunch bet, Jay. I will take it. Jay, you're coming back on when that thing's over 10. I'm going to look out for you in the chat. But I'll tell you right now, I'll take that bet any day that it will never see 10 again. Come to my house. I'll take that bet. All right, guys, so let's keep rolling through here. I know we got Power Hour coming on next. It's probably Thursday, so my man Hot Stocks Luke's might blow your ears, but stick around for that. Chris, what do we got coming on next week? Any big interviews that you want to kind of preface a little bit?
I'd have to look at that calendar, but I know our man Zoli has been busy booking lots of interviews. So, guys, you want to stay tuned with us. We just brought you another one today. We're trying to bring you interviews every day that we can. I know that in the future, we actually have, we talk about these celebrity and these athlete SPAC deals, right? We're going to get an interview with one of those names, hopefully before anyone else does. I'm not going to tell you the name today. I know I'm excited about it. I know you're excited about it, Mitch. But, you guys, you do not want to miss these interviews coming up.
Yeah, one thing I definitely mention is, guys, that we do get love out there, guys. TJ from AvPoint was definitely hitting us up on Twitter over the weekend, letting us know how much he appreciates SPACs Attacks coverage, and he wants to come back. So I'll be working to get that interview back for you guys out there. I know that we hit that question a lot in the chat. So like always, guys, smash the like button if you enjoy getting value out of this SPACs Attack team. And like always, guys, there's going to be people that are going to start hating on SPACs, telling us that we're going away. But guess what? When we come back, we're going to come back roaring, baby. So if you want to stick around with us, smash the like button, hit that subscribe bell, and it's time for the Power Hour.
Can I just interrupt for a second? I'm sorry. I don't mean to harsh.
I'm not stuck. I was just messing.
Okay. I just want to clarify something with regards to
thank you, Spencer.
The Benzinga Pro discount code, because Jonathan Mallard was like, this is a direct quote from Jonathan Mallard. He's like, I was being too cute. So here, there's clearly some confusion on the discount code. Our fault. I'm going to lay it all out there right now. If you enter the discount code YouTube20, lowercase YouTube20, that'll get you, it's on the screen right there, YouTube20. That'll get you 20% off any Benzinga Pro subscription, any tier, any a monthly, an annual, an essential, a basic, any, right? I think that 47 number was causing some confusion because it was based on the value of an annual subscription versus a monthly subscription. Too confusing. No more. We're done with that now, okay? YouTube 20 is just straight 20% off anything. Essential, basic, monthly, annual, any combo. 20% off. YouTube 20, all lowercase. That's the new code. pro.benzinga.com. YouTube 20. I got it from the man himself, Money Mallard, and that's our story, and we're sticking with it.
Guys, don't miss out on that code. Like I said at the start, Benzinga Pro, that's where you're getting all these headlines from, where you're getting all these movers from, these earnings. You don't want to miss it. I mean, that's where I get my news from for headlines for this show half the time. So take advantage of a deal like this while it's out there.
Wait. Only half of what's about the other half? Is what I want.
The other half's up here. It just comes to me.
Get it right.
Comes to me in my dreams. Chrisopedia hard at work, even while I'm sleeping.
Get it right. Don't get it twisted.